if you figure the banks win almost all the time in this environment, and we're at, last fall, $18, $19 silver, currently $22, $23 silver, and the banks are long, well, the price probably isn't going a whole lot lower, because the banks will just continue to buy, and that's going to provide a floor. Mm-hmm. And so everybody can run their numbers and count their waves and say silver is going to 12, and like last fall, and I'm like, probably not in the way this market is structured.
Silver has had ups and downs over the past year, although it has primarily been trending higher. After dropping as low as $18 last September, the silver price rallied from early November to reach a Q1 high of $24.39 in January. Although it fell again through early March to just under $20, the U.S. banking failures that month drove silver and gold upward, with the white metal climbing to $26.07, its high point so far this year, on May 4th. While silver cooled off after that peak, it wasn't a drastic fall, and the metal could test $25 in July. Craig Hemke, the founder of the TF Metals Report, believes that banks tend to have the upper hand most of the time in the current environment. He points out that in the context of silver prices, despite fluctuations, the bank's tendency to go extended means that the fair price of silver likely will stay relatively high. Hemke emphasizes that while some might project silver to drop to 12, he disagrees with this projection due to the market structure. He highlights the imbalance between the number of large speculators or hedge funds long on silver contracts and the number of short positions. When the long places significantly outnumber the short positions, historically, around a 3-to-1 or 4-to-1 ratio indicates an overheated market. This imbalance often leads to a reversal in the market sentiment, causing a price shift. Gold prices climbed to 2-week highs on Thursday as a retreat in the U.S. dollar and Treasury yields revived investors' appetite for bullion as they wait to see what interest rate signals central bankers offer at the Jackson Hole meeting. However, the silver price fell from 0.5% to $24.19 per ounce. Hemke observes a period of downward movement in gold and silver prices, which he refers to as the dog days or summer doldrums, typical for August. Now let's watch excerpts from Craig Hemke's interview with Palisades Gold Radio. Be sure to watch the entire video and consider subscribing to our channel. Don't forget to enable post notifications to stay updated on our latest uploads. Thank you, and enjoy the video.
When the amount of large speculator or hedge fund longs exceeds the amount of shorts on about a 3-to-1 or 4-to-1 basis, if they're long 100,000 contracts and short 25,000, that's a 4-to-1 ratio. That's pretty frothy. Mm-hmm. And that's just been the history of it. And then it rolls over, right? And so, what I'll do is I'll watch that. That hasn't happened now for quite a while. I mean, right now we're like at 1.3-to-1. I mean, I think it's 40,000 versus 30,000 or something like that. So, I mean, that's the flip side where it's like, oh, okay, well, now we're kind of set up, we're washed out, if you will, to rally. And then you can break down even further historically. Like I said, just go back to last year, you can find these 4 occasions where the banks, as classified by swap dealers, were suddenly, they were the ones net long 15 and 18,000 contracts, as I wrote in that article, and the hedge funds were short. And again, recognizing that, well, let's see, the last 3-4 times this has happened, maybe I can get ahead of it this time. And then what's it going to take? Like I said, you get Powell next Friday, maybe that'll do it. Maybe it's a jobs report on the 1st, and the reaction to that all of a sudden the dollar pukes a point, silver all of a sudden bumps, and it sets off this cascade of these hedge funds that are now losing money, and they're like, or they've got a small gain left, and you rush to cover, and that's more buying. And then maybe you get a technical signal that says, oh, we should go long here. Now you're buying again. Mm-hmm. And that's how those spikes happen. This current period that we're in, where gold has been down 9 days in a row and silver's been down 7 out of 9. I call it the dog days. People call it the summer doldrums. Mm-hmm. And it's this month of August is always like this. And what I mean by that is most American and Canadian traders are like, trying to squeeze in one last vacation before the kids go back to school. August, for anybody listening from Europe, everybody gets the heck out of town in August, and they take holiday, mm-hmm. And head down, wherever, go to the coast somewhere. And so you're left with low volume, kind of light volume, and an even greater percentage of the trade every day just being these HFT trading algorithms. So they're pre-programmed to buy and sell, go long or go short based off of these signals that they're picking up. And the two main signals are what's going on in the bond market and then what's going on in the dollar. Mm-hmm. Well, for the last 2 weeks, bonds have been selling out. Hell, the yield on the 10-year note's up like 60 basis points in the last 4 weeks. The dollar index, where when we were cooking back a month ago in the middle of July and it was breaking down through 100, it's now back up over 103 and just been dripping higher every day. And so without human beings around to, kind of factor in the fundamentals of all this, the silver supply deficit, whatever, it's just the machines, and the machines on a daily basis. They see dollar go up, rates go up, and they dump whatever gold they have or silver they have, or they maybe go in short, and that's how these positions get built up. Mm-hmm. And that's why you just get this steady drip down.
The Federal Reserve has raised interest rates to their highest level in 22 years in an aggressive bid to curb inflation, and more rate increases may still be on tap if the economy's strength causes inflation to rebound. Hemke believes that the interest rates are now increasing, which means that when the government refinances its debt, it will have to pay higher interest rates, leading to significantly increased interest payments. This will strain the government's budget, as the interest payments could double or triple, becoming a significant part of government expenses. He predicts that this situation could lead to the U.S. government facing difficulties in managing its finances, potentially causing economic issues. Regarding precious metals like silver and copper, Hemke emphasizes that despite factors like supply deficits and decreasing stockpiles, their prices are primarily influenced by futures contracts and the activities of bullion banks. Let's get back to the interview.
Of the current $32 trillion, mm-hmm. That's listed, of the actual, we can talk about, unfunded liabilities and all that stuff. But you look up the national debt clock and it's 32 trillion or 33 trillion now, whatever it is. Of that, 24 trillion is in short dated maturities that are going to mature over the next 3 years. Mm-hmm. Okay. That means they're all, maybe what's the average coupon? What's the average interest at coming out of, zero interest rate policy for the last 10 years? Maybe 1.5. Powell's got the 2-year note up here now, almost at 5. So that's where when you're seeing, you go on Twitter, you read, newsletters or whatever, and you read and you see those charts of just the exploding, we'll just call it a line item of a budget, because the U.S. doesn't really have a budget anymore. Where it, used to be $500 billion a year, and they kept it in that range because, again, rates came down and the Treasury Department kept shoving everything into the shorter end where the rates were the lowest. Well, now it's time to pay the piper. Mm-hmm. And as that 24 trillion matures and gets refunded, one, you got to come up with the 24 trillion. Okay. And then it's going out now, and instead of 1.5%, at 3% or 4.5%, and that $500 billion a year in interest, that doubles or triples too. Mm-hmm. And at that point, very soon here, the U.S. that's going to be behind Social Security, maybe the number one item in the budget will be interest on the debt. And you begin to just dwarf the amount of revenue that comes in. I mean, the amount of, how's the government get money? Through taxes and fees and all this other crap. Well, we're heading into a recession. Already, government tax receipts are down like 7% versus last year. So the amount of money they're bringing in is going down. The money that's going out through, the entitlements that continue to grow, but then this line item of, an extra $1 trillion a year in interest, the whole thing just begins to spiral out of control. It's what I've always called the end of the great Keynesian experiment. It's a mathematical certainty. And now, after 10 years of talking about it, we legitimately stand on the cusp of watching this whole thing finally spiral out of control. You mentioned silver, and we talk about what the Silver Institute say, 237 million ounce supply deficit last year, right? Mm-hmm. And you think, well, surely, and you look at gold and you hear about all this central bank gold demand. And you think, well, surely this has to have some physical demand, has to have some impact on price. Well, in the current structure, what moves price are the futures contracts. And so really it's the supply and the demand of the futures contracts more than anything else. And as long as the banks, those bullion banks, can flow metal primarily through London at that price, then it all kind of keeps working. Mm-hmm. I remember seeing earlier this year Even Goldman Sachs put out a thing that they thought the global copper stockpile could be exhausted. Above ground copper could be exhausted by August. Checks watch. Isn't it August? Right? So, okay, maybe that drawdown's been a little slower than usual because, China's economy or whatever. But you would think this would have an impact sometime soon. And yet copper got up to $4 a pound a couple of weeks ago. And all of a sudden, because the dollar went up, it's just gone back down to 370 or 380. Mm-hmm. If, when, whatever, copper starts rolling to the upside again and gets above 4, another 10% above there, we start talking 440 and 450. And, the thing could feed on itself. It could do it like what nickel did a couple of years ago. The relationship to copper and silver, again, is kind of dollar-based, but nonetheless, anybody can plot the two of them together over the last 20 years and kind of see them. They're not tick for tick, and the scales, they don't just lay right on top of each other, but you can see them kind of tracking each other. And right now, silver is, on that historical basis, seems to be pretty undervalued versus copper when you plot them together. So we'll see. Again, like I said, I would have thought if this physical situation, these dwindling global stockpiles, and again, you may have seen the charts, Tom. I mean,
yep.
You used to be 1 million pounds of it, or whatever it is, tons, in all the different global stockpiles, and now it's down to 200,000. And you think, okay, I can see where this, but certainly has an impact on price. I don't know. I keep referencing that I think things are going to change in September.
Silver has been trending higher over the past year, but the long-term outlook for silver is positive, as the metal is used in various industrial applications and is also seen as a haven asset during times of economic uncertainty. What are your thoughts on the future of the silver market? Please share your thoughts in the comments section below. If you found this video informative, remember to give it a thumbs up, subscribe to our channel, and enable notifications to stay informed about our latest videos on silver, gold, and copper. Thank you for watching, and we appreciate your support.